A dancer making millions in the stock market? That sounds impossible, right? But that's exactly what Nicolas Darvas did. With no formal financial background, he turned $36,000 into over $2 million in just 3 years. How? Not by luck, not by insider tips, but by developing a system that changed the way he approached trading. What if there was a method that could help you filter out the noise and focus only on high-potential stocks? Darvas found that method, and by the end of this video, you'll know exactly how he did it and how you can apply his strategy too. Stick around, because this is one story you don't want to miss. Early life. Nicolas Darvas wasn't born into wealth or finance. He was born in Hungary in 1920 and studied economics at the University of Budapest. But instead of becoming an economist, he followed his passion for dance. Alongside his half-sister Julia, he performed across Europe and the US, sharing stages with stars like Judy Garland and Bob Hope. But while he was entertaining crowds, something unexpected happened. He discovered the stock market. Initial encounter with the stock market. Nicolas Darvas's journey into the stock market wasn't intentional, it was a stroke of luck. While performing, he was paid in stock instead of cash. At first, he didn't think much of it, but when he checked later and saw the stock price had gone up, he became intrigued. Curious about the potential to make money without actively working for it, he started investing. However, like many beginners, he relied on tips from so-called experts, brokers, and even friends. At first, it seemed easy. He made a few small profits, but soon losses wiped out his gains. He realized he had no real plan. He was simply following advice and hoping for the best. The market seemed unpredictable, and every time he thought he was making the right move, it backfired. Frustrated but determined, he decided that if he wanted to succeed, he needed to stop guessing and start learning. Development of the box theory. As Darvas continued studying the market, he realized stock prices weren't moving randomly. There was a pattern, a structure beneath all the chaos. While traveling from city to city, he spent hours analyzing price charts, looking for clues that could help him predict future movements. That's when he made a breakthrough. Stocks seemed to trade within specific price ranges before making a strong move up or down. They weren't just bouncing around unpredictably, they were forming invisible boxes on the charts. This led to what he later called the box theory, a strategy that changed everything for him. The rules were simple but powerful. When a stock stayed within a certain price range, it formed a box. If the stock broke above this box on high volume, it was a signal to buy. If it fell below the box, it was a warning to sell or avoid the trade. By focusing on stocks that were breaking out of these boxes with strong momentum, Darvas removed the guesswork and let the market show him which stocks were ready to rise. Instead of predicting, he reacted to price action, only buying when his conditions were met. Implementation of the box theory. Once Darvas refined his strategy, he made a radical shift in his approach. No more following stock tips from so-called experts, no more buying on gut feelings, and no more reacting to financial news. He cut out all distractions and focused solely on the numbers. His only concern? Stocks that fit his box theory ones, showing strong momentum and breaking out of their price ranges with high volume. This discipline paid off in one of his most famous trades, E.L. Bruce, a flooring company. While most investors overlooked it, Darvas noticed something different. It was forming a clear box pattern with increasing volume. He waited patiently, watching the price action closely. Then the breakout happened. The stock surged past its upper limit, confirming his theory. Without hesitation, he bought in. The results? The stock skyrocketed, bringing him massive profits. And it wasn't a one-time fluke. His strategy kept working, again and again. Darvas had cracked the code. He wasn't just another trader gambling on the market. He had built a structured, rule-based system that eliminated emotions, allowing him to act only when the market signaled the right time. Instead of chasing stocks, he let the right opportunities come to him. Challenges and adaptations. Success didn't come easily. Even with a solid strategy, Darvas faced setbacks, doubts, and the urge to second-guess himself. Market downturns tested his patience, and at times he wondered if he should adjust his method. But every time he strayed from his rules, he was reminded why discipline mattered. He learned 3 key lessons that shaped his success. Discipline is everything. Sticking to his strategy, even when emotions told him otherwise, kept him on track. Losses are part of the process. Not every trade was a winner, but by using strict stop-loss orders, he kept small losses from turning into disasters. Patience leads to profit. Instead of jumping into trades impulsively, he waited for the perfect setup. Have you ever struggled to stay disciplined when things got tough? Darvas did too, but his ability to trust his system, even during challenges, is what made all the difference. Unlike traders today, Darvas didn't have real-time charts, online brokers, or financial news at his fingertips. Instead, he relied on weekly financial publications like Barron's and communicated through telegrams while traveling. This limited access to information actually worked in his favor. It kept him from being swayed by day-to-day market noise and forced him to focus only on clear, high-quality trading signals. Could cutting down on information overload improve your decision-making too? Criticisms and controversies. When someone turns a modest investment into millions, people start questioning whether it's too good to be true. And that's exactly what happened to Nicolas Darvas. His rapid success in the stock market caught the attention of skeptics and authorities alike. Some traders dismissed him as just another lucky gambler. Others went further. The New York Attorney General launched an investigation, suspecting some form of fraud. But after looking into his trades, they found no wrongdoing. Despite the clean record, many still doubted his story. Critics assumed that his profits were simply a matter of luck or timing. But those who carefully studied his box theory saw the truth: his success wasn't random. It was built on logic, discipline, and strict risk management. Would you trust a method backed by clear, repeatable rules, even if others around you were skeptical? Darvas did, and it changed his life. Legacy and lessons for modern investors. Darvas's journey offers lessons that are still relevant today. Follow trends, don't predict them. He didn't try to guess tops and bottoms. He followed momentum. Cut losses early. He never let a bad trade wipe him out. Stop-loss orders protected his capital. Ignore noise. He focused on price action and volume, not financial news or market opinions. Stick to a system. He developed a clear, rules-based approach and never deviated from it. Many of today's best traders use strategies influenced by Darvas's work. His box theory remains a powerful way to identify breakout stocks with real growth potential. Nicolas Darvas's story proves that success in the stock market isn't about luck. It's about having the right system and the discipline to follow it. From a struggling beginner to a millionaire investor, his journey shows that anyone can succeed with the right mindset and strategy. If you learned something valuable today, let me know in the comments. Have you ever followed a trading system like Darvas's? What's your biggest takeaway from his approach? Make sure to like, share, and subscribe for more content like this. And don't forget to hit the bell icon so you never miss an update. Who knows? Maybe the next great stock market success story could be yours.